One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's Nightmare Winter. You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, the US, plus 3 large properties in Europe. Bonner says, we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. Bonner has made 3 similar predictions in his 50-plus year career, and each one proved to be exactly right, although he was mocked each and every time. That is why I strongly encourage you to read about Bonner's fourth and final prediction, totally free today. It's all spelled out in a free report we've put together about America's Nightmare Winter scenario. Get the facts for yourself. Go to AmericanWarning2022.com to get your free copy of this report. Even if he's only partially right, it will dramatically affect you and your money. So again, www.AmericanWarning2022.com.
Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's December 6, 2022, just a few weeks away from wrapping up a wild 2022. On today's show, we're going to start looking ahead. The rest of December, we're going to be looking ahead to 2023 and all the great things lining up for the next year. I know it's hard to believe now, but we have a lot. And specifically on today's show, we're going to start building our watch list of stocks for next year. All that and more coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It's December 6, 2022. If it looks a little different in the background, most people can't tell the difference of which studio I'm in, but I'm back here in Baltimore. And, this sweatshirt probably looks a bit familiar. And the reason I had this on is because I don't have any winter clothes right now. I need to go into my storage facility to get winter clothes. I didn't realize shorts and T-shirts aren't working up here, up north right now in December. And first time been in cold weather in almost a year. So it has been an eye-awakening morning here for me. But that being said, it feels pretty damn good. It's a holiday spirit right now. And we want to take that optimism that typically goes along with the holiday spirit and start getting ready for next year. In my opinion, it's never too early to start looking ahead and coming up with some good investment advice and education. And of course, ideas that we can have ready for when the market tells us it's time to really push into the market, push it back into the pot, take some cash in there. So we're going to talk about that today, as I mentioned. We have had one hell of a rally over the last 2 months. And if you take a look, the last 2 months heading into this week, we're up about 14% in the S&P 500. A lot of people are saying, well, this is just a bear market rally, similar to what we had from June through August. We had a big rally then as well. We came up to that downtrend line that I'll show you here in a chart in a second, and then we failed and hit a new cycle low. Well, again, there's a lot of people that are saying that we're setting up for the exact same thing. I don't know, because I'm looking at the numbers right now, and when we rally about 14%, over 13% in a 2-month time frame, if we go back since 1950, we've had rallies like this in bear markets 13 times. When it's gained over 13% in a matter of 2 months or less. And if we take a look, it's the average gain 1 year later of those 13 instances that since 1950, the average gain has been nearly 21%, 20.7% to be exact, and up 12 of 13 times. So sure, there's an odd chance that this is just another bear market rally and we get hit new lows. I think the odds of that happening are extremely low. Do I think we go straight up from here? And no, I don't. So let's take a look at the chart here and show you what I'm looking at. Here's a chart of the S&P 500. And that white line, which I've drawn in the past, that is our downtrend line. That connects the lower highs along the way. And of course, you can see we've had lower lows along the way. And we're right up against that now. And we're starting to roll over a little bit as we try to break through, not holding. But again, we're just consolidating near that resistance level, if you will, which is that downtrend line. But again, we have some other things kind of going in our favor right now as well. The blue line, tough to see. We closed above the 200-day moving average. And when we break above the 200-day moving average in this situation, which I'm going to show you a chart here in 1 second, when we have a situation like this, you can see here, after 7 months, the S&P 500 finally closed back above the 200-day moving average, meaning it traded below the 200-day moving average for 7 months. So this came from Carson Investment Research, Ryan Dietrich over there, which, of course, we've had on as a guest in the past not too long ago. But in the past, when this has happened, again, going back to 1950, folks, when the S&P 500 closes above the 200-day moving average after being below it for 6 months or more, you can see the performance going out. 1 month, 3 months, 6 months, and 12 months, the average gain for all those time periods is positive. And the percentage of it being higher, again, let's look a little bit further because long-term investors, 6 months, 12 months, 92.3% of the time, all but once, all but 2002. Every time this has happened, the market's been higher 6 or 12 months later. And again, you look at the average gain 6 months later, 12.2%, 18.8% for 12 months looking out. So again, these are historical numbers that I like to use, and I use these often. And I started really kind of delving into these the last couple of months, and the market has actually kind of gone along with what a lot of the historical numbers have told us. And the market is never the same as it was last time. This pullback's not the same as a pullback that we had a couple of years ago. It's not the same as a COVID or 2008 or 2000. Driven by different situations. That being said, and I say this often as well, we're still humans. We react to the news in a certain way, which is typically panic or FOMO, fear of missing out. That's on the upside. The panic has been setting in for a while now, and it's been a bit of a torture because, yes, we've been below that 200-day moving average for 7 months now until we closed above it last week. So this could be setting up again, showing that there has now been a shift in the thought process of investors as money starts to come back in slowly. There's still a lot of money on the sidelines. The negativity is still out there. So there's no reason to think you missed anything, because once this does take off, I think we're going to have a bit of an upside that lasts for quite a bit of time. And just to give you an idea of the last 2-month rally, we've been climbing what they call on Wall Street a wall of worry, meaning the market typically goes up and a bear market ends when things are still really bad. And we know the Fed's going to raise interest rates in mid-December, most likely 50 basis points, which the good news is after 4 increases of 75 basis points, maybe they're starting to tick it down a little bit. That could be a really good sign going forward. And that 50 basis points already priced into the market. But again, if we take a look underneath the hood, folks, you look at the AAII, American Association of Individual Investors. They do their weekly bull, bear, neutral. We've now been negative, net negative, which means you take the bulls minus the bears, and it's been negative, meaning there's more bears than bulls for about 36 weeks now. That's the longest ever since they started doing the AAII several decades ago. The longest we've been negative consistently. So again, 2022 has been a very odd year. It's not, it's not 2002, 2003. It's not 2008. It's a bit different because we've had this prolonged negativity. And a lot has to do with the fact that the Fed is raising rates in a situation where the economy is not booming. Very rarely happens. So the situation is different. All that being said, what ends up happening is it creates bargains in solid companies. When those bargains happen, whether it's down 40%, 50%, some down 70%, very difficult to identify that. But again, as long-term investors, I believe we are now in that sweet spot. I don't think we break below the October lows. I could be wrong. I don't think we do. Could we come down from here? Absolutely. I think the odds of that are pretty good. I think we're in a volatile December personally. It really depends on not what the Fed does. I think 50 basis points is baked into cake. What Fed Chairman Powell says and what other Fed chairmen say in between now and then and after then until the next meeting, which is going to be on February 1st, is when they come out with the next interest rate decision, which depending on which way it goes, will be 25 or 50 basis points. I think if inflation starts coming down, and I believe it will, we will see most likely 25, and that will be really the Kickstarter to pushing this market higher. And I've said the canary in a coal mine for inflation, I've been saying this for months, folks, is shelter. Shelter makes about 1/3 of the CPI, of the inflation number. And shelter is rent prices and home prices. Both have been rolling over dramatically. According to Apartment List, rent in 93 of the largest 100 cities decreased last month. 93%, 93 of the top 100 cities saw rent come down. That will spill over to the shelter number. And when it does, it's a bit of a lagging indicator here. But when it does, you will see inflation come down. Inflation's peaked, folks. It's peaked. That's a given. I'll argue that with anybody. It is peaked. It doesn't mean that it's going to come down to 5% tomorrow, but it's peaked. We're on our way over. And the fact that we're rolling over, coinciding with the Fed likely slowing down interest rates, coinciding with the market making what I believe was a bottom in October, it's all positive heading into 2023. Which brings me to really the crux of this show, folks, and that's going to be looking ahead to 2023. And again, for the rest of December, we're going to be doing a lot of outlooks. And if you follow me for years, I always do fun predictions, real predictions, but I throw in some fun ones as well. And we're going to be doing those prediction shows between now and the end of the year, dispersing them throughout, talking about how to really prepare for next year. And again, a lot of things can change throughout the year, but we want to take what the market's given us, look back in history, look at valuations of stocks, sectors, individual stocks, and come up with a nice watch list, which I started this weekend. Again, as I said earlier in the show, going through several thousand, literally, charts all weekend as I watched football and soccer and every other sport in the background while we did that. So these are in no specific order. Again, nothing here is a buy or sell recommendation, but let's go through a couple of stocks here and give you an idea of really what's coming up on my list and what's looking good right now as far as investment ideas. First one we're going to take a look at is Herc Holdings. Symbol is HRI, by the way. It's a $3.7 billion company. It is the third largest equipment rental company in North America. Number 1 and 2 are United Rentals, which is publicly traded, URI, and Sunbelt Rentals. They have a fleet size of about $5.4 billion, so a huge fleet. And even though they're the third largest equipment rental company in North America, they only have 3% market share. So I like that because I think there's a lot of upside potential to gain a market share throughout that. So HRI, as I mentioned, about a $3.7 billion company. And one of the things I like to see is companies that have continued to really grow their revenue over time, over the last couple of wacky years. We go back to 2020, about $1.78 billion in revenue. Last year, 2.07. This year, looking for 2.74. So you're looking for a nice big bounce up. And by 2024, looking for nearly 3.5 billion. So if you look at that, we still have a nice, kind of slow grind going up. And then it comes to the bottom line. This company is extremely profitable for being a mid-cap company. Last year, they earned $7.52 a share. This year, looking for $11.45 by 2024. Again, it's 2023 in less than a month. 2024 is not that far away. Looking for $15.10 a share. It trades, folks, with a forward PE ratio of 9.2, forward price of sales of 1.1, a PEG ratio below 1. So the valuations are really inexpensive compared to the market and compared to its peers. And if we take a look back, at historically where it is, the price of sales got up to basically around 3 in 2021. We've cut that in half. So that's that pendulum. The pendulum swings very far to the overvalued. Now we're swinging back to the undervalued, creating opportunity in a company like this. And if we take a look at the chart, very impressive chart. You can see it broke above the high of August here, pulling back, consolidating. It's above the 200-day moving average, which is a blue line. It's above the 50-day moving average, which is a red line. The 50-day moving average is moving up about to cross a 200-day. That is typically a signal that the trend has changed. The other thing I like about this, when the market hit new lows in October, this company did not. It bottomed out in June, July, and it held well above that, about 15% above that low. It didn't come down and break it. So these are the types of companies we want to look for. And again, equipment rental, you think, well, why equipment rental? I don't care what happens with the government going forward. We need to spend more money in infrastructure, and we're going to spend more money in infrastructure. And that is going to lead to large corporations renting, not purchasing these big vehicles, but renting them. So this is a company, again, I believe in for so many different ways, technically, fundamentally, and just a big picture story as well, the theme of infrastructure going forward. So that's stock number one. The next stock is going to be a bit bigger, and you might think this is crazy, because it is Yum China Holdings. Yum as in yum, tastes good, Y-U-M. The symbol is YUMC, and they have about 10,500 or so units over in China. It's the largest restaurant chain in China. You know their brands. KFC, Pizza Hut are the two big ones. And they have a couple smaller ones as well, but those are really the two big chains. And of course, there's Yum here in the United States, which owns KFC and Pizza Hut here as well. But this is the Chinese portion of it. About $23.5 billion company. And again, you kind of look at the financials. It was able to grow even through COVID. It continued to grow. A small growth, but it grew through COVID. 2020 had sales about 8.26 billion. Looking by 2024, about 12.7 billion. So about 50% over that time frame. And we must look again at profitability, because right now you want to see companies that are profitable. It doesn't mean all of them are going to be profitable, but it does help lower the downside risk. It made $1.21 last year. This year, looking for a little dip down to $1.11. But again, by 2024, more than doubling in that 2-year time period to $2.28 a share. Not as cheap as HRI, but it's in a different category. Forward P ratio about 29, forward price to sales about 2, PEG ratio a little below 1, which is a really nice indicator showing that the growth is outpacing the valuation that we're seeing for Yum China here. And again, we want to take a look at the chart, because we need to make sure the chart is coinciding with what we're saying. And look at this, folks. Trading this at a new year high today. So, again, nothing's a buyer seller recommendation, but you never chase something when it goes from 38 to 56. It probably pulls back and consolidates. But again, it's breaking out. It didn't make new lows in October. It's above the 50-day and above the 200-day moving average. And again, you might say, I don't want to invest in China. I don't trust China. That's fine. You don't have to. I'm not telling you to do anything. But diversification is a nice thing to have in a portfolio. And again, this stock's actually up this year. China's down, the US is down, but this stock is actually up this year. The next company is going to be a little bit bigger as well. Another foreign company, but I think you're really going to like this one. And this is SQM is a symbol of this. It's based in Chile. I'm not even going to say the name of it, because I'm just going to butcher the hell of it, even though my Spanish is getting better. I'm not going to butcher it. But it's one of the largest lithium producers in the world. And we all know the demand for lithium for batteries, more specifically electric vehicle batteries. As more electric vehicles come on the road, which they are. I just saw Cowen came out this morning, and last night I was reading it, that they've upped the adoption of electric vehicles for 2025 and 2030, up their numbers, which are already high. So you're seeing the adoption really happen. And I don't have a vehicle, but I look around, and boy, oh boy, they're everywhere. Everywhere I look, there's more electric vehicles out there. So this is a company that is going to be a play on the increasing demand and limited supply of lithium going forward. As I mentioned, about a $27 billion company. And we're really seeing revenue take off. Last year, 2.8 billion. This year, looking for 10.6. So, and it's going to be kind of stagnant, but after that big jump, you're not going to see it go too much. If you take a look at the bottom line, again, making money. It came in at $2.05 a share last year, well above the estimates. And a bit of a change in the company. So we're looking at $13 this year, $13.50 next year. Again, looking out, forward PE ratio of 7, forward price of sales of 2.5, very attractive. But again, we must come down and take a look at the chart. And look at this chart. Again, it's up for the year, above the 50-day moving average, above the 200-day moving average. Didn't make a new low in October like everything else. So you're seeing there's a bit of a pattern here, folks, that we're looking at, that these trends, they have legs. And the 3 trends I talked about so far will continue to move higher, in my opinion. HRI, we talked about. Herc, infrastructure. I don't think there's anybody's debating we need more infrastructure, and that's going to help a company like that. Yum China has to do with the fact that when China does reopen back up, this company held up even with the zero COVID that they've had over there. Once it opens back up, boy, oh boy, you should really see a pickup in sales. And then, of course, the lithium trend is going nowhere but up over the next year, decade plus. Another one that kind of falls into that theme category, folks, is Cheniere Energy, and the symbol LNG. And the symbol is LNG because it's a company that deals with liquefied natural gas. And it's a company that I've followed for many, many years. They operate the S.A.B Pass, which is down in the Gulf down there, Gulf of Mexico. And they also own a development in a Corpus Christi LNG terminal that's under development right now as well. It's one of the largest LNG companies out there. It's a $43 billion company. And what we're seeing is the situation that's going on in Ukraine with Russia. Obviously, there's more demand for gas, and obviously we're the kind of the Saudi Arabia of natural gas here in the United States, well, with fracking that's taken place over the last decade or so, and we can now liquefy that, put that in special tankers, and take it over to Europe and sell them the natural gas that they need, especially in the winter months. 60 Minutes last night, which I can barely watch anymore. It used to be one of my favorite shows. But Macron, the leader of France, was on, and they were talking about how he was a bit upset because they're in need of natural gas, and so the U.S. is saying, "Yeah, we'll sell it to you, but they're selling it to them at huge profits." So companies like LNG, Cheniere, are doing really well because of that. And if we take a look at the revenue spiking from $9 billion, about $9.4 billion in 2020. To 15.7 or 8 billion last year, looking for 31.6 billion this year. It should kind of even go down a little bit, but it's such a low valuation up there. It's tough to ignore. Forward P ratio of 9.2, forward price of sales of 1.6. And again, got to look at the chart. Here's a chart of Cheniere. Just off an all-time high, but the 50-day, but the 200-day didn't break a new low in October. Again, you're seeing that. And again, the theme of LNG moving forward, there's going to be more demand for LNG, liquefied natural gas, because even if things get better in Ukraine, there's still going to be demand for this, and the prices will come to a level that it makes it economically attainable for Europe and other countries to start importing some of our natural gas that's liquefied that will LNG Cheniere and will help take care of. Kind of going to go with one more kind of big theme here. Another foreign company, and again, this one I didn't do this purposely. It's just these were the ones that were popping up, and this one I can pronounce because it's pretty easy to pronounce. It's Grupo Aeroportuario, del Pacifico. This is a operator of 12 airports on the Pacific coastline of Mexico. Most of the about just over half of their passengers that come through are domestic, but a lot come from America. And the largest airport they have is Guadalajara. That's about 30% of the entire passenger traffic that they do in their 12 airports. But they also have a bunch of tourist places, Los Cabos, Puerto Vallarta, where I was married, my first marriage, my only marriage, and some exposure to Tijuana, Southern California. They also have two major airports in Jamaica, Kingston and Montego Bay. Montego Bay was about 10% of the company's traffic. So that's another big one. But I just came from the airport this morning. I'm in airports all the time, as you know. It's crazy. Hotel prices. If you looked at hotel prices, just pull them up if you're bored one day. Look in New York City for hotel prices. They're through the roof. People are traveling. It's back. Now, numbers show, the TSA numbers show we're basically, if we're not back, we're 5% within the highest levels that we've seen since pre-pandemic, especially for these warm places that people want the hell out of there. People that used to go to Mexico all the time haven't gone in years. They want to go for the holidays. They want to go when it's the kids are on vacation. So this makes perfect sense to me. Again, I mentioned this one's about a $7.7 billion company. We've seen obviously a dip in revenue in 2020, fell from $842 million in 2019 to $556. But last year, back to a new record, $937 million. This year, looking for $1.34 billion and continue to increase. So we've come back all the way. So if we take a look at the chart, as you can see here, that's why the chart looks so good. Again, this is another stock that's up in 2022. It's pulled back from the high. Boy, this looks very nice down here, but still remains above the 200-day, the 50-day, didn't break to a new year low in October as well. So again, that's one I would throw on my watch list. But when we put all this together, we want to stick with the trends that are working. Everything I talked about here has a big, major trend behind it. We're looking for the trends and the themes. We're looking to buy solid companies heading into next year. And that's what we're seeing. We're looking at companies that have been growing revenue consistently, growing the bottom line consistently, have good valuations based on their specific sector and based on where they've been in the past. And again, good looking charts, and finally fit into major themes. So this is just the beginning of our outlook for 2023. This is our initial watch list we're starting with. Of course, we'll add stuff throughout the next couple of weeks. We're going to talk about some big picture stuff heading out next year, how to allocate your money. We're going to bring on one of my research associates to sit down with me and let him fill you in on what we've been doing behind the scenes. We have a lot of great shows planned. We have a prediction show coming up. But don't forget, we have one more interview next Thursday. We're talking cryptocurrencies. We know cryptocurrencies had a wild year, to put it really nicely. So we're going to kind of dive into that for Thursday's show. And then after that, it's all about looking ahead, folks. Looking ahead to 2023, taking an optimistic view, because historically, when you have years like this for the market, where bonds get hit, stocks get hit, inflation's going up, interest rates going up, overall markets going down, it usually sets up for one hell of a rebound. And we want to be ready for when that happens. And I want to be here for you when that happens. So once again, thank you so much for watching. I hope you have a wonderful rest of your week. We'll be back Thursday with a great interview, diving in what the hell's going on with cryptocurrencies. Thanks for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.